These types of risks, I should probably add, are also very nuanced, right? A good example might be assets in the Philippines. The rule of thumb has always been you need not only the support of the local community and the local government, but you also need the support of the Catholic Church. I say that flippantly, but I mean,
true.
It makes a difference, right?
Yeah,
Like you
it
just
does.
don't want, and it's something, of course, that you just don't need to worry about it in other parts of the world.
Welcome back to another episode of Alpha Uncovered. My name, of course, is Alvin. I'm the CEO of OPIM. Today, we have a very special guest, Edward Leung, the portfolio manager for the Marshall Precious Metals Fund. Edward has over 20 years of global financial investment experience, specializing in metals and mining. He holds a PhD in actuarial science, a Bachelor of Commerce, and a Bachelor of Law from the University of Melbourne, as well as a Master's in Science from the University of Oxford. Edward has previously held senior positions at Credit Suisse, UBS, and Deutsche Bank. We're excited to dive into some of the more insightful aspects of investing in the mining industry today. Welcome to the show, Ed. The macro picture right now. As of the date of recording, escalations in Middle East have gone through the roof. Iran and Israel are really at the knife's edge. And then when I look back at the last 2 years of gold purchases, it's no secret that the BRICS countries, including China, India, Russia, have been buying gold at an incredible rate. I think something like more than 200 million tons were purchased last year, in the last 2 years alone. And I think that's actually just for 2023. When you look at your framework and when you're making your projections, which guide then how you move your investment focus, say, for example, from juniors into majors, do you care? Are you monitoring, or are you keeping track of these macro events? And if so, what are you looking for that would indicate an end to this opportunity window, or perhaps extending it out?
So yes, we do follow macroeconomic events very closely. It's clearly the main driver at the moment for the underlying commodity for us, which is gold and silver. We've been sort of pretty consistent in the last 12 to 18 months that macroeconomically there are lots of things that are aligning to say that gold should continue to hit all-time highs. So even when gold was trading at 1,700, 1,800, and even beyond 2,000, it was clear that at some point interest rate reductions would have to take place, and that would be very, very positive for gold, because of course interest rate reduction is now the largest driver for
risk assets, for everything.
Yeah, for risk assets, for everything. You mentioned the geopolitical tensions. Very simplistically, the world looks hard going forward, and that usually bodes well for gold. It's looking harder going forward rather than easier. And the central banks, they're buying at significant rates as well. And it's not just the BRICS countries, it's sort of, even smaller economies popping up as being sort of quite significant buyers of bullion, Poland, Ireland, in this example. Your question's probably a hard one for us to answer in terms of what would signal the end of this sort of cycle, because the way that we're thinking about them at the moment is that we're still very early in the innings of this whole thing, right? So we think that there is a lot more runway for this gold price to go. We wouldn't be surprised if the gold price would exceed $3,000, certainly by the middle of next year, 2025. It's only sort of recently, and when I say recently, in the last couple of weeks, that almost all of the sort of major investment banks and investment houses are increasing their gold forecasts going forward. And even beyond that, bullishness sort of would extend. So one of the things that we have started to think about and we've already executed upon is that we talked a lot about gold, Alvin, right? But gold is sort of the first beneficiary of what's happening macroeconomically. As an extension to what happens to gold, our expectation is that silver will follow, right? And so the view that we are holding is that at some point, as part of our portfolio construction, we would look to basically gain more silver exposure to the portfolio, which is also well within the mandate of the Marshall Precious Metals Fund. I'll give you a good example. I mean, at the moment, or at least the last sort of 12 months, the gold-silver ratios have been trading certainly between 80 to 100 times. So the price of gold as a quotient to the price of silver is probably 80 to 100 times. About 10 years ago, that ratio was less than 50,
Wow.
right?
So there's a lot to catch up on.
There's a lot to go. I mean, like this thing only probably has to mean revert and you've got it doubled, right? So yeah, I mean, at the moment, hard to sort of really sort of pinpoint. We're not, maybe I can say it, we're not necessarily looking for an active sell signal.
It's interesting that you mentioned silver. I was on another call recently which talked about the spike in demand, both from EV technologies, solar, and thirdly, AI for both gold and silver as main components for hardware. Do you monitor these types of demand drivers as well, beyond the macro side? Do you look at sectorial demands?
We do it simply because we know there is an industrial use for silver that is not necessarily captured for gold. So
Right, but that doesn't drive price, or is it more of the gold ratio arbitrage that you think
in
is?
theory, it should be driving the price of silver.
Right.
In many ways, that's why we have a view that gold-silver ratio should revert, because that, as you point out, the demand for electrification, solar panels, electric vehicles, all this industrial demand should at some point be captured and reflected in that gold-silver ratio, which should in turn be reflected in the silver price. But of course, at the moment, it's not. I mean, of course, it has moved up. I mean, there was a point where it was of trading at the teens, $13, $14, $15 and in the low 20s, and now it's approaching $30 an ounce. But the reality is that we really want to see a breakout beyond $30 an ounce of silver. And then I think we'll be off to the races there. An investment in silver for us would also have implications in terms of where our portfolio construction, because it's not just gold versus silver, but the majority of the big silver miners are listed in Canada, right? Which would mean that we would obviously be shifting more towards the TSX. At the moment, we're probably more towards the ASX, but it would have an impact there. The second implication, as I mentioned before, is on the geographic exposure, which is the majority of the silver exposure listed in Canada is in Latin America.
Interesting.
So that would mean that we would need to basically start to become comfortable again with our exposure to, say, jurisdictions like Mexico that have also very recently had sort of mining code related issues. So all that sort of stuff we monitor. At the moment, sort of the silver exposure that we have is, funnily enough, it is, of course, it's a Canadian listed company and their assets are in Morocco. So not Latin America, but obviously North Africa.
Right.
But again, I think having that in our portfolio, at least very recently, Alvin sort of demonstrated that we are thinking about silver. It's certainly an active part of the mandate. It will become more of an active part of the mandate, I think, as we see the sort of the evolution of the gold price play out and that momentum shift to the silver space. By way of the strategy, the Marshall Precious Metals Fund was essentially conceived in 2020 as a partnership between myself, Jia, one of the other portfolio manager in OPIM, as well as Jiaojin Mining, which is probably the third or fourth largest gold mining company in China that's also listed in Hong Kong. And a gentleman called David Garofalo, who at the time was the CEO of the second largest gold company globally, sits in Canada. So we conceived the fund initially as a precious metals fund, investing predominantly in the early stages of the life cycle of a mining asset, so exploration, development, but that has subsequently sort of morphed into the entire life cycle of the mining asset, if you like. The strategy itself is fairly niche, so it's precious metals equities only, so that basically means gold and silver mining companies with a touch of PGMs as well. We're geographically agnostic, meaning that the assets or the underlying assets that we'd invest in, we're not necessarily restricted geographically where they are. So many investors would typically only invest in, let's call it safer jurisdictions like Australia or Canada. We, on the other hand, would assess the risks and be able to venture out into various jurisdictions within Africa, West Africa, Latin America, and so forth. We invest at all levels of the capital structure, so equity, debt, mezzanine level as well. And I think the other great thing is that we're very flexible in the manner in which we make our investments. So we've done private placements. We'll take private placements. We'll trade on the secondary market. We've even sub-underwritten for some broker-dealer issuances in Australia, and we can do that in Canada as well, both on ASX and TSX. So.
Would your team also invest into the unlisted portion of the investees? So this would be kind of like almost private equity-like type of exposure or mezz financing which would tend to be obviously more illiquid?
Yeah, there is certainly scope for that. We haven't got anything in the book right now, but we are able to invest in sort of pre-IPO situations or even sort of much earlier stage situations, as you point out, would be significantly less liquid than obviously anything that would be in the public space. Notwithstanding that we don't have anything private in the book at the moment, we've seen a lot of things that are being presented to us just by virtue of our network. And the reality is that nothing's actually sort of met our criteria at this point in time.
One of the ways that you described the strategy is almost like a private equity approach to public equities. Is that a fair statement?
Yeah, it is, Alvin. We're very sticky capital. So it takes us a long time to make an investment. I mean, we have a very in-depth diligence process. We can talk about that a little bit more, but we take a lot of time trying to understand the technical risks surrounding an asset. And that includes everything from geology, engineering, metallurgy, and so forth. So, once we're sort of comfortable with all that, which is not an insignificant sort of undertaking to get comfortable at a technical level, we'd often take a position with a view of supporting that management team as progress on the asset improves. So it might just simply be that they're doing exploration. If exploration's successful, then we'll average up and we will continue to support these teams as they progress through that life cycle. So it might be an investment in a pre-resource situation, moving on to development, and then potentially moving on to ultimately production. So yes, there are some flip sides to sort of having that type of private equity approach, meaning that very difficult for us to participate in, for instance, Canadian overnight bought deals. If we get a call from Bay Street and they say they've got something open and they need a bid by tomorrow morning, more often than not, we're not going to be in a position to bid unless A, it's an existing position that we're already comfortable with and we're not at the current position that we want to be at, or we've done significant work in the past on the asset and we already have some comfort around that. So yes, we're very much a long-term sticky capital approach.
When we talk about sticky in private equity, the first thing that comes to my mind as an allocator is it's also captive capital. So for investors who are looking at strategies like this, what type of time horizon are we looking for commitment? Because I would imagine that it may be liquid to some extent, but the expectation for investors is to stay with the fund for a longer period of time. What type of time horizon are we talking about?
Yeah, so there are a few types of ways that we think about it. So if we, for instance, taken on a position at the exploration stage, expecting that there is going to be successful exploration because for whatever reason we think that it's a prospective region or they're exploring in a prospective belt, then we would want to hold that position for the duration of their exploration campaign, which could be years, right? So this could be a 1 or 2 year proposition or even longer. If we think that on the basis of the exploration, there is enough within the asset to move towards production, i.e. development and then production, then we would make a decision at that point as to whether or not we think that that management team is capable of moving exploration projects into development and construction and take a view. Do we want to stick around for even longer for that period of time? So more often than not, when we make an investment, we have a somewhat multi-year view, irrespective of almost what part of the life cycle of the mining asset we're investing in. The only sort of caveat to that, Alvin, would be if we have invested in a situation that we think is an event-driven situation, we think it's likely to be taken out, in which case we will hold until the thesis either plays out or does not play out by way of a takeover. And we've done that a couple of times, meaning that the length of the hold has been shorter than 12 months.
So for these types of investments, it sounds like there's a proclivity towards junior miners and at least emerging miners. For these types of projects, as you reflect on how dynamic these timeframes can change, because moving from exploration to production, as you mentioned, could take years, for example, and often in the middle of these periods, there's very little opportunity for a liquidity event. As a fund, how do you look at positioning your book knowing that there's going to be limited liquidity until the catalyst hits over the course of the 2 to 3 years?
We think about that in a couple of ways. I mean, the first thing is that notwithstanding if we make an investment in a company that is at the exploration phase, and it may take years before it goes towards production or even development. We want to make sure that we are backing a management team that will progress the asset technically and inform the market of its drill campaigns, drill results, assay results, feasibility studies on a timely basis. So we often think that there are always going to be those catalyst events throughout the year or throughout the quarter. That is a sort of a very important criterion for us, is just to make sure that we are backing a team and also an asset that's capable of having at least some news releases, and at least they're drilling and producing results at a rate that doesn't make the market, I suppose, forget about it for a period of time. Second way we think about it is that we don't have the entirety of the portfolio in, let's say, exploration. So we make sure that we have portfolio construction, which has a good portion of the portfolio in production assets, as well as a good portion of the portfolio in development and construction. And in many ways, there's a construct in the mining space called the Lassonde curve, named after a very famous Canadian investor/mining entrepreneur. And it essentially shows the development of the life cycle of a mining asset from exploration through to production. We try and make sure that we have exposure at all levels of that curve, just to make sure that we have the liquidity if and when we need it, throughout the year.
Is there an optimal, the Lassonde curve that you mentioned? And for those listening, maybe you can describe, are there different inflection points on that curve where you can capture the highest value? And what are those points?
Yeah, absolutely. So imagine the Lassonde curve basically being an S curve. And so there are going to be inflection points around the exploration point of the curve, particularly if there is a resource declaration. So a company might be drilling for a period of time, and once there's sufficient data to declare a resource on the mining asset, then at that point in time, upon declaration of a resource, if it is a good grade and if it's of substantial scale, then there will be quite a meaningful inflection. The other inflection point that we try and capture is that point where the company transitions from construction through to first production, which is often a very sort of difficult segment to invest in, because not only are you taking technical risk on the asset, but you're then subjecting yourself to construction risk as well. So there are lots of projects that are over budget, not on time, not to spec, and so forth, which obviously...
I'm reminded of the property. It's almost similar to how off-the-plant property development is, where there is a significant uptick in valuation once the land has been rezoned and licensed for development, and there's some pre-sales that occur at that point. And then there's this long duration of execution risk or development risk, where financing is very, very hard to find up until there's the first build. Is it similar in mining as well, where there's an easier time of raising capital in the beginning with maybe prop capital or mezzanine financing, but the middle, is there a section of the curve where it's very difficult to finance because of execution risk?
Yeah, absolutely there is. I mean, flip that question another way. The easiest time to raise capital is either just after you've declared a resource, in which case if it looks promising, then people will back that. Another good time to raise funds would be after a feasibility study, i.e. a study which determines whether or not the asset is capable of becoming a mine. And if that study sort of demonstrates that it is economically viable, then on the back of that, then equity markets and even the project financing market would basically use that as a basis to raise capital. Where it's particularly difficult to raise capital is clearly during situations where the exploration results are not favorable, or if you're in the middle of construction and you've got a budget overrun. And in that situation, obviously, very, very difficult, like in any, I think, sort of heavy industrial, even property development type sector. That's the difficult segment.
I would imagine, especially if you're in the junior mining space, there must be a tremendous amount of emphasis on due diligence. In my early days in investing, I've always been warned by peers in the sector that, especially being Canadian myself and you're Australian, we both come from commodities-driven markets where a lot of scams, a lot of fraudulent activities are in the junior mining sector. That was maybe 10, 15 years ago. Do you still see that type of behavior today? And number two, when you do due diligence, maybe you can give us one or two red flags that are more obvious to you now than maybe when you first started.
Alvin, there's definitely lots of over-promotion in the industry, right? Particularly when you are a junior mining company spruiking prospectivity on your property, right? It's inevitable. They're going to say that this is going to be more prospective than what it might ultimately be. I think I've got a couple of comments on that. I mean, I think firstly, our team has been in the space for decades, both through the markets, through the corporates, and even technically. So the sector is one almost where you could characterize it as you know what good looks like, right? So when we do
Can you give us a couple of examples? Yeah, for maybe you can share like one or two flags that you've seen recently. You're like, you know what, this doesn't pass the sniff test, and what would that look like?
Yeah, so for example, there might be claims that processing plant can be built for X, and we just know that there's absolutely no way that you can build that for the amount of money that you think that this is going to require. And that might be for a number of reasons, and not necessarily through over-promotion or outright fraud. It might simply be that we don't think that the management team has properly understood the geology or the metallurgy. So we came across a situation where it was claimed that for this particular asset, a processing plant would cost X dollars. Our internal view was that the metallurgy of the asset was more refractory than what they were telling the market, which would therefore mean that it would require additional circuits as part of the processing plant, which they didn't factor into. And so therefore, for us, that wasn't going to fly for us in terms of cost. The other thing that is a red flag is, particularly at the exploration phase, some management teams might claim that they've got a potential multi-million ounce resource under the ground on the basis of just a few drill holes. And, you know, for us, we would require certainly many more drill holes put in the ground. I mean, you've got to remember, when a geologist puts a resource number around a resource, they're guesstimating or making estimates around the continuity of the ore body. They're making guesses around the shape of the ore body. So it's a matter of opinion to a certain extent. So we value our internal opinions in those situations, obviously, much more than what we're being told, or at least we try and verify or validate what we're being told. So those are the key sort of red flags. And of course, we're always very careful, Alvin, in terms of what the burn rate is, the cash burn rate I'm referring to. So many of these companies in the mining space, you hear the term lifestyle companies, right? So we're very careful to make sure that the money that's being raised or the money that we invest in these companies going directly into the ground, you know, as opposed to salaries, G&A, and overseas travel.
So at Marshall Precious Metals Fund, major outperformance this year, 24.9%. You guys beat out the gold index, 21.2. You even beat the junior gold miners ETF, the VanEck, 18.1%. It's been a great year, a lot of backdrop. Why don't you walk me through what your winners were this year and what you're happy about? And then maybe a couple of words about what you're not happy about.
So the funds performed exceedingly well both last year and year to date this year. And we did a couple of things that I think were very important to sort of achieve that performance. You know, I mentioned earlier that the fund sort of began life as being focused at the junior end of the mining life cycle. But what we purposely did about 12 months ago was to rotate many of our positions away from the junior end and move up the value curve towards more liquid and larger producers. And the thought there was basically that we knew that when the gold market turned, that the large bellwether names, if you like, those that are producing, those that are more leveraged to the gold price, would be the first cabs off the rank, certainly for generalist buyers. So we made a concerted effort to get out of some of those smaller positions into the larger positions. I think that's the first thing that's important in terms of what we did.
How did investors react to that? Because here's a strategy that is, at least in the beginning, more focused on junior, early stage. Now you're moving into the larger names. Is this a temporary move? I'm touching on this as some investors may or may not regard it as style drift, even though your mandate is quite wide. What are your investors' reactions when you communicated this to them?
The reaction was very supportive. And I think the main reason for that is that there was always a view that the move towards the senior end of the gold space was temporary. And looking forward, the view from us would be that once perhaps towards the late end of 2025 or mid-2025, we'd eventually rotate back out of the seniors and back into the juniors. To be very clear, not for the sake of just doing that, Alvin. We'd be doing that because the trickle effect of the impact of a strong gold price on the gold equities would first hit the seniors, and then that would trickle down the value curve towards the juniors. So the idea in its most simplistic terms is capture the value that's going to be achieved with the seniors, first cabs off the rank, and then follow the flow of capital down the value curve. So
Yeah, that makes perfect sense.
yeah, so that was the first thing that we did, and the second thing we did was we also repositioned the portfolio with respect to sort of the geographical jurisdiction profile to move towards sort of the safer jurisdictions over that period of time. And once again, this was because we held the view, which we believe to be correct, that generalist investors, once they become attracted or once they want to bid for gold equities, would initially at least look for assets that are either in Canada or in Australia, rather than some of the far-flung jurisdictions like Central Asia, North Africa, and certain parts of Latin America, or even sort of the Pacific Rim. So that was the second thing we did. And the third thing that we did was we put on some positions that we thought would be taken over. And again, just given our relative backgrounds in the sector, it's always the view that big cap corporate development and M&A teams at the start of a bull cycle in a commodity space are basically buyers at the very start.
So you mentioned M&A. One of the names I caught a glimpse of earlier was Newmont. They did an acquisition of Newcrest, but this was 2023. Were you referring to this one, or was there another event that your team was able to capture in the last year?
Yeah, certainly the Newmont-Newcrest deal was one of the larger ones that took place in the space. And for us, that was a signal that M&A was going to start, and it's always the case. Once the big guys basically execute on the deal or the obvious deal in the space, pretty much signals the start of that bull run. What I was referring to was perhaps some of the smaller positions that we held that we specifically put on because of our view that it was going to be taken out, obviously much earlier than what we thought. One such situation was more of a merger, that there was a couple of companies that we held in our portfolio, Canadian listed and Canadian run company with assets in Brazil. And there was another company that they had combined with, which was called Reunion Gold. So that was just an example of something that's happened in our portfolio through the M&A lens.
What kind of impact does that have on the company in terms of valuation when it goes through an acquisition like that? And it doesn't have to be this case, but maybe you can just give an example, because it sounds like this is one of those inflection points that you mentioned earlier. One is exploration, another is production. I guess, is this a third type of inflection point for acquisition, or it's more attuned to the liquidity event?
I think there are a couple of comments from me on that one. The first one is that in the mining space, you can grow in two ways, either organically or inorganically, right? So given that precious metals equities has been going through such a sort of a bear market from about 2013 to 2017, there has not been what they call sort of proper resource or reserve replacement. In other words, a company might have a set of resource numbers that's just depleting, and they haven't been investing in exploration enough to replenish that. So the easiest thing to do at the start of the bull market is just basically just buy the resources, right? And so typically for companies that are in that scenario, you could, in theory, basically boost your resource and reserve numbers or even your production profile number up and get a re-rating on the back of that. Because of course, mining companies, one of the ways that you could value them is as a capitalized resource multiple, capitalized reserve multiple, or even a production multiple. So we were always of the view that there had to be M&A in the space for the basic reason that there was not enough money plowed into the ground by the mid-market producers or the senior producers for the last 6-7 years. And we've been very consistent about that thematic, Alvin. And that's not just a North American phenomenon, it's globally. So yeah, the expectation is that we should see certainly more M&A coming. There are obvious M&A trades. You mentioned the Newmont-Newcrest one. I think some less obvious ones that are out there where we continue to do work around whether or not we think it's actually credible or viable combination for those companies to be put together, in which case we'll position accordingly. You're absolutely right. This would follow the sort of the regular sort of takeover type of premium that you'd expect to see, which is sort of in the range of 30-40%. The one thing that can get us caught up is in situations where it's a sort of a nil premium deal or something like this, which we've seen as well, right? You know, positioning on something, at the end of the day, it becomes a paper nil premium deal and, you know, bad luck. Okay, we'll move to the next one.
Your book looks like it would lend itself to a more concentrated portfolio than a broader one, like an ETF or an index. So as a portfolio manager, how are you looking at risk? Because on one hand, like most private equity funds, you're going to have a concentrated book and it's going to be a longer duration. You're going to expect a lot of unrealized volatility in the interim. When your team looks at building the book, how are you adjusting the guardrails and the goalpost when you are both allocating capital and ensuring that you have sufficient concentration, meanwhile keeping the book relatively diversified? Or are you not looking at diversification?
So we're very clear at the outset with our investors that it is a concentrated book and it's a long duration investment. We've never shied away from that. I think that's a very important point. What we've always said to our investors has been, look, if there is a portion of your portfolio that you want to allocate to gold, whether it be 5, 10, 15%, whatever it might be, then, you know, that portion, send us some of that our way and we'll manage that portion. So we are not necessarily saying to people, you know, we're going to deliver an index-like return. Absolutely not. I think that's the first point. The second point is that in terms of risk, we have obviously a number of risk management tools or hard risk management tools that we're using. So the first one is we can't have a position more than 25% of the portfolio. That's the first thing. We don't have a stop loss, and there's a recognition that, again, these are sort of somewhat small and potentially liquid positions, and there could be meaningfully significant drawdowns for a long period of time before there is success with the asset. And we've seen that in the history of Marshall over the last few years. And at the end of the day, if we still believe in the long thesis of the original investment, that at the end of the day it recovers and actually performs much better. That being said, we try and manage the liquidity of the book through, as I mentioned earlier, a combination of having not only just small illiquid, small cap precious metals equities in the portfolio, but also some of the larger cap ones. And we have a position across all of the stages of the life cycle of a mining asset. We have the portfolio constructed on a diversified basis across the various exchanges globally. So naturally, we'd have positions in the majority of the positions on ASX and TSX, but we'd also have positions in London and New York, to the extent that the large guys trade in those markets. And it would also, of course, have a portion of cash that's left in the book. We have never been anywhere sort of beyond 90 to 95% invested.
We talked about the junior mining space. The team has been actively and dynamically allocating to larger names now. And you did make a point earlier that the expectation is investors who are first coming into the gold equity space would prefer to have at least majority exposure in developed countries such as Canada and Australia. In our last discussion, we did actually talk about dabbling into West Africa. So walk me through the thesis here. I understand that it's going to be a smaller position as you move in, but you know, why West Africa? Why now? And what does this mean for the book?
Sure. The West African continent, or West Africa for gold in general, is quite simply, in our view, sort of misunderstood. And there are a few reasons. The first reason is West Africa, not all of West Africa is risky. There are certain countries that are good, there are certain countries that are not good, and it basically takes our experience to know sort of what's been working well and what's not been working well in various jurisdictions there. So a good example is that Côte d'Ivoire is a great jurisdiction to be investing in at this point in time. Burkina Faso, more challenging, much more challenging.
Why? Why?
Could be security reasons. There might be pockets of militia/military activity that's going on in a particular country, or there might simply be a risk of nationalization of assets, which is always a risk in third world countries with very well-endowed mining assets in country. So our view is that we've reviewed sort of many of the jurisdictions in West Africa We think we know which ones are good jurisdictions to invest in. The other reason for us is that, I suppose, misunderstanding of West African risk translate to very attractive valuation at this point in time. So we've seen a run now in the gold price and therefore gold equities, which has seen some of the assets in Australia and Canada sort of move up in value. There has, of course, been some accretion in that in valuations in the Africas, but not as much. So to give you an example, producers trade probably at a 20% price to NAV discount in West Africa versus its peers, its global peers. And for the junior guys, up to 30-35% discount to on a price to NAV basis.
That's massive. And is that cheap because of the country risk, or number one? And then number two is, will you see a markup at all, given that it is a country risk where you may not see a markup unless there's a catalyst for a change in the market's perspective of these regions, or otherwise an acquisition?
We certainly think there's going to be a markup. I mean, the discount's there for a number of reasons. Maybe a good example is, say, Mali at the moment. Mali is sort of going through a mining code regime change. Not necessarily a regime change, but more of a change in how they manage their natural resources in country. And dial back the clock 6 months ago, that is viewed as, wow, that's a big red flag, right? But 6 months down the track, there have been now some examples of where a new mining code has been agreed with certain companies. We've seen what those agreements look like, and it looks fine. And so therefore you'd expect to see collapsing in that discount. So that's, I think, a good example of some of the arbitrage that can be taken advantage of in that part of the world.
But how do you capture an arb like that? And I ask this because when I think of regime change, even in developed countries, even in the US or Canada, you have differing governments that come in and out every 4 years. And so even a change in a developing country can shift policies that could affect valuations in a negative light or positive, depending on how you look at it. With these more developing countries or underdeveloped countries, these can change very quickly, or even if you give them the benefit of the doubt, they could change in 3 to 4 years. Does that mean that your intention is to exit the position before the next regime change, and is there liquidity for that?
Yeah. Make no mistake, I mean, we're not blind to, or we're not ignorant of the risks posed by those type of regime changes, right? We're not going to make an investment on the back of we think there are going to be favorable mining terms reached with the government in due course, which of course there's no way to know that. So yes, for sure, we would want to take a view as to how stable a particular jurisdiction is before actually making that investment. We've been caught on the wrong side of those types of trades before, and so we've learned from that. We'll size our position accordingly, but more often than not, we have the benefit of our own network sort of understanding what is likely to happen in those certain countries. I mean, to give you an example, one of our general partner has assets in West Africa, right? So we at least have a sense as to what's going to work and what's not going to work.
You have boots on the ground already, it sounds like, with one of your partners, yeah.
That's right. Look, I mean, and just to continue on with the West African thematic, we like it because it's a cost-efficient jurisdiction, and we can't escape from the fact that both in Australia and Canada, you might read in the mainstream press that a truck driver in the mines is getting paid $600,000 a year to work 7 days on and 7 days off, simply because they have to live in either the extreme north of Canada, where it's absolutely freezing cold, or in central Australia, where it's very, very hot. Typically, those labor type issues, I mean, they're obviously existent still in West Africa, but what I'm talking about is the cost effectiveness of operating in West Africa, which makes sort of the margins much better, and therefore the operations quite attractive.
This reminds me of some of the questions I see happening in the IR meetings with some of the larger mining companies, where ESG and ethical mining is a big question. For investors looking at your strategy, are they concerned about ESG? Are they concerned about ethical mining practices? And I guess when you look at even junior miners or more established miners in the West, you're not going to have as much of a lack of transparency. But when you look at West Africa, for example, how do you answer questions like that for your prospective LPs?
ESG, climate risk, community risk, that is part of our diligence process, Alvin. So we take it really seriously. And the reason why we do so is because it basically translates to the stock price. As it relates to West Africa, let's call it, there are certain risks that are more prevalent. They are usually sort of community type risks, i.e. the relocation of villages, relocation of communities, which more often than not is sort of done quite cooperatively. The mining companies would relocate certain communities to sort of better accommodation. They would build schools and so forth. Compare that to the type of ESG, climate, community style risks that are prevalent in Australia/Canada, which in my view can be even more risky. And those issues are things like native title, right? Indigenous related issues. Those things are they're practically deal killers, right? I mean, if you find an ore body on sacred land in say Canada, it might be a Nunavut sacred land, you can forget a mine ever being built over there. And these types of risks, I should probably add, are also very nuanced, right? A good example might be assets in the Philippines. The rule of thumb has always been you need not only the support of the local community and the local government, but you also need the support of the Catholic Church. I say that flippantly, but I mean, it makes a difference, right?
Yeah,
like you just don't want. And it's something, of course, that you just don't need to worry about it in other parts of the world. So, yeah, look, we take those considerations really seriously. Our LPs want to ensure that we are cognizant of those risks simply because, particularly in the mining space, it can translate to basically a zero, potentially, on an asset, or at least a very, very significant drawdown. And, we've seen it more times than we care to remember.
I'm going to wrap up, Edward. I think this has been an incredibly insightful discussion. I have one more question for you, and it's something that I'm going to start asking more of our guests moving forward. I mean, for all intents and purposes, you've been running the fund for how many years now? It's been 4 years. Yeah, 4 years. In terms of track record, you're past that important 3-year mark. So 4 years are considered a mature fund by many standards. At least you check off the first box for institutional. As a fund manager and as a founder, tell me something that you would tell yourself that you know now that you didn't know when you first started the fund.
So before being on the buy side, I was on the sell side as an investment banker, and of course in the same sector that we're operating in now. I think the one thing I'd tell myself is that you know a lot more about what's going on in the sell side by way of, I suppose there is much more of an informational advantage when you're on the other side of the wall.
The flow,
yeah. And I think one has to remember that if you're on the other side of the information barrier, don't necessarily think that when you're on the other side of the information barrier, information flows easily or even gets there at some point, or even if there is. I suppose what I'm trying to say, Alvin, is that you think you might know a lot about what's going on in the market when you're on the inside of the information barrier. When you're on the other side of the information barrier.
when you're on the buy side.
Yeah, when you're on the buy side, very, very, don't overestimate what you know.
Yeah. I think that's true not just for concentrated strategies like yourself, but generally for other hedge fund strategies. I find that there are a lot of managers who spin out or come out from the sell side, and they regard themselves as very profitable traders because they perhaps made a lot of money when they were on the sell side book, either for clients or for the proprietary book. But the moment that they come out and they set up their own shop, there's a sudden silence on day one, a quietness, because a lot of the edge that they had when they were making money for the firm was because of the flow that the firm enjoyed. But now that they've spun out, a lot of that flow is not accessible, at least not without a tremendous amount of investment.
Yeah, absolutely. Completely agree.
If you were to give one piece of advice to new fund managers or someone who wanted to start a fund today, what would that be?
Just be flexible. We've gone through a few iterations of the fund by way of the manner in which we've invested in what we've invested in. Even the investment process has gone through a number of iterations. I think that being humble enough to know that your mind should be flexible enough to change as and when things happen, I think that's very, very important.
That's very, very sound advice. I want to thank you again, Ed. It's been a real joy and pleasure working with you over the last 4 years. And congratulations again on 2024, 2023. You guys have knocked it out of the park. Looking forward to catching up with you again in a few months.
Thanks very much, Alvin. Thanks very much for the support and the opportunity to have this chat this morning.